Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Kathy Kriske, Commodities Strategist at Invesco. So we are talking about the outlook for commodities in 2023. Kathy, welcome. So nice to have you on the show.
Thanks so much for having me, Nina. Very happy to be here.
So I believe you love commodities. So let's talk about commodities. So commodities has been the best performing asset class in the last 2 years. And particularly last year, when stocks and bonds had a terrible performance, commodities did quite well, particularly in the first half of the year. Commodities were very hot, and that is mainly because of disruptions caused by the war in Ukraine. Later, investors became slightly cautious on commodities because worries shifted from inflation to economic growth slowdown. Now, so far this year, commodities performance has been kind of lackluster despite China's reopening. And we'll talk about China's role because China is one of the biggest consumers of commodities in the world. And I think this is mainly because of easing inflation. So many economic reports are pointing to easing inflation all over the world, and commodities are seen as an inflation hedge. And the US dollar also has been weakening. So tell us about what kind of performance you expect from commodities in 2023.
You said it all, Nina, right there. I love that intro because, yes, we did it. Commodities, as you said, we were the best performing asset class for the second year in a row. Like, this hasn't happened in a very long time. But our main broad-based commodity ETFs, which are PDBC, and that's like Papa, Delta, Bravo, Charlie, PDBC, and DBC, Delta, Bravo, Charlie, like they follow the same index, right? Which is production weighted. So think like heavy energy. So they returned for the year, for 2022, just under 20%, right? So compared with stocks, like you said, that were, like, I think the Dow was down 7% for the year, and bonds, like the Ag Index, was down over 13%. So, what are we looking at for 2023? And I feel like I always have to set the stage by saying, like, I'm very nervous about being overconfident on a forecast because first and foremost, commodities are volatile. So we could see a very wide range within the year. And as you pointed out for last year, right? Last year, PDBC was up 40% as of June. I was just looking at June 1st. It was like 39.9% returns for the first half of the year. But then a combination of factors, which you alluded to. So again, part of it was China lockdowns, the large SPR release, fears of a recession. Remember? So back then, people were really worried about a recession and that it was going to hit last year, right? And then be fully entrenched by this year in 2023, which we have not seen, at least in the US. So that, but again, finishing the year with still that 20%, like, led our investors to be happy about that, right? A nice double-digit return in a challenging year. But they had to live through some of those volatile swings. I had a client on earlier this week, and he said, yes, we ended the year up high, and all of our commodity investors are happy, but they didn't like those month-to-month moves. And I was like, I agree. Nobody likes that, right? Wouldn't it be nice if we had an investment that just steadily went up every month? I would love that. But that's not what happens. And it certainly doesn't happen with commodities. So if we look to 2023, so there are analysts out there right now at some of the very well-respected banks that are calling for like over 40% returns for commodities for 2023. But there are others that are forecasting that this asset class will be down, right? That we've seen the best already, and that will be down over 10%. So this is a really wide range for the asset class. But I have to say, personally, I'm in the camp of the positive returns for 2023, but I think it's more likely to be in those low double digits. So I'm not saying 40, I'm not comfortable saying 40, but could we see 10, 20 plus? Yeah, again, but with swings in between. So based on what we know now, and again, everything is constantly changing. That's why I always joke that I feel like I am a commodity teacher, but I have to constantly be on the lookout for everything that is impacting our market. But the biggest factors for 2023, I wanted to bring them all up. But the first one, and you mentioned it, China reopening, right? So as you said, remember, China is the biggest buyer of commodities, full stop. And they've been in, they're just coming out of like 3 years of hibernation due to the COVID policy there, and just, having to deal with COVID in a really amazing way, right? They put their people ahead of the economy, right? Because they really wanted to preserve life. And that was really, really important to them. But this move of the reopening is going to require a lot of patience, but it will be ultimately bullish almost every sector of commodities. But the other big factor is the war in Ukraine, right? We are approaching the 1-year anniversary of this conflict involving 2 natural resource countries. So it doesn't seem like it's ending anytime soon, unfortunately. But this war risk premium has left a bunch of these markets. Like, we look at wheat specifically, that's a great example. Like, wheat has been trading much lower because Russia basically delivered record wheat crops and exported a record amount of wheat. So there are some markets that still have that war risk premium in it, like refined products and maybe gold, but others it has left. So that's what we can talk about, just one of the downside risks later about the peace in Ukraine. But another big factor is the energy transition. So watching the U.S. jumpstart this, like the shift away from fossil fuels to deal with climate change, right? I was in the Middle East a few weeks ago, and they said that phrase, energy transition, so many times, I just started writing ET. So I will refer to ET, right? And it's not ET phone home. This is the energy transition ET. But it is ultimately bullish commodity prices. And again, we can go into that when we go sector by sector. But another big factor is weather, right? Many commodities trade on weather. You look at natural gas right now, what's happened? Natural gas has totally collapsed, right? Because of the record warm weather, both in Europe, right, and in the US. But also like the grains, the softs, diesel fuel, the heating oil, a lot of these are greatly impacted, right? And think about the climate change, right? We've seen more extreme weather. So that is an important component. Another thing that's not so obvious though, but that's really important, is the cost of borrowing, right? So obviously the Fed, like the rates have been going up, and this, as they continue to move higher, the cost of bringing these commodities to market is becoming more expensive. So, and without sufficient capex to provide this supply, commodities could remain tight fundamentally with higher and more volatile prices, right? And the other thing that I briefly mentioned was this recession risk, which everyone was obsessed with last year. But again, it's still in the background there. And when people ask me about recession, I usually say to the investors, you have to consider your own views, right? If it will happen, when it will happen, and how it will happen. So statistically, commodities tend to be a good place at the start of a recession. So I think the math works out too. Like, we are the best performing asset class, when 0 to 5 months after a recession is deemed to have started. And then 6 to 11 months, we tend to still be positive when other asset classes are negative. But we get in trouble with the 12 months plus, right? And that's when the fear is that this is going to be a deep, long recession, which could possibly be causing permanent demand destruction. And that is bad for commodities. I always say, when people are like, what does that mean, permanent demand destruction? I joke that I remember inflationary times or whatever, and then we were in a recession, my parents, family of 7, and they bought a little tiny Volkswagen Rabbit, like diesel car. And I always picture that clown car. That is permanent demand destruction, buying a more fuel efficient car or buying an electric vehicle. And that's where a deep recession, like a 2008 recession, really can hurt commodities. But as I said, we tend to be a good place to sort of hide out if the recession went, in the 0 to 12 months. But lastly, OPEC actions, right? OPEC's always in the background, right? And right now, again, being in the Middle East, we were spending our time with some of the OPEC oil ministers, and they always say they're never targeting a price for oil specifically, but we know generally that if oil, specifically Brent, trades below $80, we could see OPEC coming back in and cutting production further. They already have a big cut on that they've had on for a while. But if prices also escalate into the triple digits, that also concerns them. So we could see an increase in production if we see really high prices, because they're always concerned about demand destruction. So I know I covered a lot there, Nina, but I just wanted to go through, these are, as I said, some of the biggest factors that go into a 2023 forecast.
Very interesting. And that was an excellent summary of factors that will drive commodity prices this year. Now, you mentioned both PDBC and DBC. So for the benefit of our listeners, I'd love for you to explain the differences between these two ETFs. PDBC is the most popular commodity ETF, and I believe it is the best ETF, one of the best ETFs to gain broad exposure to the commodities as a group, to the entire commodities universe. And in full disclosure, I do own PDBC in the ETF investor portfolio that I manage. So please tell us about how investors should decide between PDBC and DBC.
Okay, great question. So PDBC is, as you said, it's very large, right? And it's very popular. And I think too, it's priced, I hate that word cheap, but it's priced very attractively. Let's say that at 59 basis points. And so PDBC is an actively managed 1940 Act fund. Right now, DBC is a 1933 Act fund, and it issues a K1, whereas PDBC issues a 1099. Now, when DBC came first, and it's more expensive because that's how much they all cost back then. But it is they both trade off the same index, and it's a very enhanced, innovative index that Deutsche Bank created because it uses this thing called optimum yield. So there's only 14 commodities in these two products, right? The same index, and they're the 14 most actively traded commodities. And I'll explain why those 14 were chosen. But we are production weighted. So when you hear that phrase, production weighted, it basically tries to reflect the real world, that of all the commodities produced in the world, about 55% are energy, about 23% are metals, and 23% are grains and softs. So that's how it got the weighting. Again, it was to reflect the real world, production weight, right? Because we have heavy energy, as I said, like 55%, we tend to be this great inflation hedge. And that's why I think we've seen such massive inflows into this product, because commodities are a very efficient hedge for inflation, because you don't need a big asset allocation for commodities to mitigate your inflation risk. So that's it on the weights, production weighted. But on the index methodology, commodities have this, we have these commodity forward curves, right? These futures curves, and they go out some of them go out many years, right? The really liquid markets go out 3+ years. And so but it's important to understand the shape of that curve, right? So in like interest rates, you have like an inverted yield curve and a regular yield curve. Well, in commodities, we have contango and backwardation. And I know they sound like complicated words, but I always say to people, the way to understand it is backwardation signifies scarcity. Think about like the commodity, people are desperate to have it, so it's expensive right now. So that front month price is really high, but over time it goes down, right? The reverse is true of contango. So contango signifies surplus, right? Think of like the shale revolution, loads and loads of crude, we're drowning in crude oil. So the front month price is low, and then the future prices go up over time. So when people were creating these commodity indices years ago, everybody wanted that like front month futures contract. Because when people say, oh, what is WTI at? And someone says, oh, $80. They're not talking about WTI in a barrel, like the physical commodity. They're talking about that first futures contract. So when they were creating these investor products years ago, like, let's just use that front month. That's what everybody's talking about. So that was the idea. But when the market went into contango, every month these indices had to roll, right? They had to sell that lower, futures contract and roll up a hill basically and buy something that was more expensive. So you're selling low, buying high. And this created this negative roll yield that everyone hated. And I feel like a lot of people that bought USO years ago when the market was in contango, like, what happened? I bought commodities, they went up, yet I didn't make any money. It's like, well, the curve is in contango. So now with all of the scarcity that we've experienced for this past year in 2022, a lot of the markets, almost every market was in steep backwardation. So now we have, again, that front month price really high. But now when the markets are rolling these futures contracts, we're selling high and buying lower. So that's generating a positive roll return. The roll return for our PDBC and DBC was actually up above 20% in the middle of this year. So that is one of the highest. I had an investor say, wow, well, how much higher do you think it's going to go? I was like, really? I'm bidding commodities almost 30 years. I don't think I've seen it this high. So I was like, be happy with your 20% extra, returns in this product. But what our product does is they say, okay, negative roll yield versus positive roll yield. How am I supposed to keep these straight? We said, let's use an algorithm that goes for the optimum yield. And that's the name of the methodology. Optimum yield looks at where do I want to be along this curve? If I'm in contango, I want to be far out the curve, out 13 months. If I'm in backwardation, again, scarcity, I want to be as close to the front as I can. So that's the reason why this product is so attractive to investors. We have an enhanced index that basically, as I said, the reason why we have only 14 commodities is because we need liquidity. So that's why they're the most actively traded commodities. But now investors can say, okay, I will let the algorithm decide for me where I should be along this curve, and then the other extra part of PDBC is that it's actively managed. So now our portfolio managers who have an average experience of 20 years, so they are deep in the weeds of commodities, they are commodity experts. They are trading around the curve, right? They can be in different points of the curve. They can be in multiple points along the curve, and they can also do relative value trades, right? If they feel that Brent is going to do better over WTI, they can overweight Brent versus TI, or they can do corn versus soybeans, or things like that, or play with some of the metals. So again, one instance, copper was doing really, really well, but the algorithm said to be at the back of the curve, and these guys are like, you know what? Let's split it. And they went 50% at the front, 50% at the back. And that provides some outperformance. And a great example is when crude went negative in April 2020, which I always refer to as the day that shall live in infamy. Brutal time. Our guys were out. They actively managed. They're allowed to go out 15 months. So they were all the way out the curve. So they did not see that dramatic move down that all the other indices saw. So again, so PDBC actively managed 1940 Act fund, issues a 1099. DBC, a little bit more expensive. It's a passive fund and it has a K1. But the other thing that's really important, which is a very boring topic, but is very important, is taxes, right? So PDBC, the commodities sit in an independent Cayman sub, and that's how they get around like issuing a K1. But this independent Cayman sub has to pay out any income each year. So if you have a great year for commodities, right, you can expect a decent distribution. And that's why for taxable investors, it's taxed as ordinary income. So very important. And that's why we say, if you can put this in a qualified account, you still get the distribution, but you don't have to pay tax on it. But if you have to have it in a taxable account, you have to, one, be aware that this distribution is coming, or shift to DBC, because DBC, again, only distributes interest income. But you have to be comfortable with that K1. So, but great question. Thanks so much for that one, Nina.
Thank you for explaining. That was quite helpful. So you mentioned different commodity groups, energy, agriculture. You talked about industrial metals as well a little bit. So I was interested in your outlook for these various commodity groups. Which group has the best outlook? Because we have seen some very interesting divergent trends this year so far. For example, crude is kind of flattish for the year. Natural gas, which was up last year, that has plunged mainly because of warmer winter in Europe. Industrial metals have generally done well, particularly copper, maybe because of China reopening. You will explain that to us. Gold is off to a strong start, and that may be because of the possibility of a recession later this year. So tell us which commodity group has the best outlook for this year in your view?
Well, this question sort of makes me chuckle because I was talking to a bunch of different analysts last week, and we were all talking about the China reopening story, which is the biggest story for commodities right now. And each different person representing the different sectors said, oh, my sector. So the first one was energy. Oh, energy will be the sector to benefit the most from the China reopening. And then the next one was industrial metals. Nope. Industrial metals is going to be the winner of this China reopen. And then the third person, grains. No. It's the grains and softs demand will absolutely increase in China. So I was laughing that like this China reopening story apparently is good for across all sectors. But in reality, right there, these sectors really should see an improvement in demand because as I alluded to, this China reopening story is this. Again, it's something that we have been waiting for years. So also an interesting point is that I had an investor call me the other day who has never invested in commodities, and then I said, what's your motivation? And he said, China reopening solely. So that's very rare because normally we have people interested in, originally it was hedging inflation, then it was diversification, then it was the geopolitical hedge, right, as we had a war. But to just have that as your sole goal, China reopening, and rather than using equities to express that, they're using commodities. I found that very interesting. So first, let's look at crude, right? That is, and the end of the story is I am probably the most bullish crude because of the effect, I think, from China. But the rebound in demand should be very supportive to prices. Analysts are estimating that the increase in demand is going to be anywhere from 1.5 to 1.8 million barrels per day. And this represents almost like 2% increase in global demand. We always talk about the 100 million barrels per day, like this demand number for demand and supply, just nice, easy to remember number of 100 million. So that 1.8 million increase is, it's a basically, 1.8% increase in global demand. That is huge. And we're all watching the mobility numbers as they start to increase in this region. And in the West, we saw this like revenge spending, right? As we were coming out of COVID. Now, China, it's very different. Chinese are very disciplined. They have a very high savings rate around, I think, like 30 to 34%. So it's unlikely that they will go through this same magnitude of spending that we saw in the West, but there will be a big increase in travel, right? We're already starting to see that. And if we get back to these pre-COVID levels for transportation in that region, this will be extremely supportive to prices. Also, China is a very large refiner. That's hence all this crude oil demand. And lately they've been exporting, right, a lot of this refined product. But as their mobility increases and they need to use this diesel and this gasoline, right, domestically, this could limit their export of diesel and gasoline. So again, supportive to the products as well. But if I look then at industrial metals, that's the knee-jerk one. That's okay. China is a massive buyer, right, of these. And you mentioned copper, Nina. So if we look at all the industrial metals for the past like 3 months, on average, they're trading 20% higher already just on this China reopening story. So that was where investors, how am I going to express my China reopening view? I'm going to buy industrial metals. But right now, we have to say that you have to be cautious, right, as we gauge what the health of the recovery in their building sector specifically, right? And we are optimistic, right? There's a lot of stimulus measures being brought in to help support the building sector. Actually, one of the quotes is the Chinese State Council emphasized the need to accelerate a recovery in consumption, making this the main driver of the economy. So again, they're basically saying like, okay, go out there and consume. So we believe because of all of this, that the demand for industrial metals will be healthy, and China will be leading the way. There are a lot of other factors that impact industrial metals, which I can talk about too. But right now, from the China story, I think that some of it has been expressed in advance of us seeing the actual consumption there. So again, we have to be patient with this story, especially for the industrial metals. But on the ags, right? We are expecting to see more robust grain imports, with China buying U.S. corn, wheat, and soybeans in the reopening. And this should be very supportive of prices. So in summary, like I said, if I had to choose one sector, I always joke and say it's like asking me who's my favorite child. So, but right now, energy is my favorite child. And but I do believe that the other sectors are going to enjoy the ride too.
Excellent. So let's talk about EV materials and the investment case for EV materials. And I love this theme because, energy transition will become a significant investment opportunity for investors.
Yes.
EV adoption continues to rise, and the recent acts, the Inflation Reduction Act, as well as the Infrastructure Investment and Jobs Act, both will be directing billions of dollars in funding to mining, battery production, EV charging, and EV car assembly. So that is why we have seen that dozens of companies have announced plans to open these EV battery factories, and there are concerns about shortage of these materials.
Exactly.
So let's start with the investment case for EV battery materials.
Perfect. So actually, I was speaking to a client last week about electric vehicle metals, and he said, I like this idea because it is investing in the future. And I try to invest in things that where we see the demand increasing over the next 5 years. And that was so interesting for me to hear that. And I said, oh my goodness, this client is actually selling this idea to me. And I love that image of investing in the future. As you were saying, Nina, like there's so much going on around this energy transition. But I do believe with the current administration that the energy transition is going to be their focus for the next 2 years. I was in the Middle East about 2 weeks ago at this energy conference, and most of the focus was on the ET and this race to reduce carbon emissions. Everyone was talking about it. And again, remember, it's a room of 800 people that are focused on energy, yet the whole focus was on energy transition. So the carbon reduction targets over the next few years are going to be challenging without a big shift to the electrification of transportation. That's absolutely necessary. And as you mentioned, the Inflation Reduction Act, the IRA, is providing funding for EVs. And I love it. It's just at the point of sale, right? You get that money back but as part of the supply chain. And a lot of money focused on building out the infrastructure. And one of the people that was in the Middle East with us was talking about that this is going to revolutionize the world. In America, we really do have to play catch up, right? We are in a race now to make sure that we as a country move forward and push forward in this energy transition. And the California announced that by 2035, the state will ban sales of new gasoline-powered cars, what we call the ICE vehicles, right? The internal combustion engines, this end of the ICE age, right? So that most new cars are expected to shift to battery power electric vehicles in California. And so I know that was shocking for a lot of people, but it was putting that sort of stake in the ground, right? To say, right, we've been a state that's been trying to be on the cutting edge of moving towards this energy transition, and we have to make some bold rules here to move this country forward. So with that in mind, we launched a product to accommodate this. The ticker is EVMT for electric vehicle metals, and this ETF it basically gives direct exposure to some of the tradable components in making an electric vehicle. So rather than buying like an EV company like Tesla, investors can move away from the drama and put their money into the metals used in manufacturing these vehicles. So the benchmark, we did a lot of research before we launched this product, and we decided to work with S&P, and they created this index called the S&P GSCI Electric Vehicle Metals Index. And it includes nickel. So nickel is the biggest at around 37%, then copper at approximately around 27%, aluminum around 18%, cobalt, and I think we were the first ETF to have cobalt in it at around 10%, and iron ore at around 8%. And the idea was to, again, provide this for investors so that what do all of these car companies have in common? They all need these materials to make their vehicles. So and this battery development, the beauty of working with S&P is that they adjust the index every 6 months and recalibrate it. So as the battery technology changes and as this whole industry moves forward over the next 5 years, this index will adapt to include some of the other commodities that are important in this really growing sector. So one of the questions I always get about EVMT is lithium. Like, where's the lithium in here? And lithium is not liquid enough yet. But again, this is an actively managed strategy. So it is also a 1940 Act, like PDBC, as I said before. So it issues that 1099 instead of a K1. But it will, the portfolio managers can shift to different weights, can shift along the curve. This is, it's not that optimum yield, so it's going to be referencing front month. So obviously our PMs are great at using the curves to enhance value. So they will be using that. And again, they are going to be actively managing this, and they are actively managing this as we go forward. But I do believe that this is the product of the future. As I said, I think that you look at copper, right? Copper, someone described it to me as the hearts and veins of an EV, right? That basically goes throughout. It's used in the electric motors, the batteries, the inverters, the wiring, and even the charging stations used. So that's why we joke about like copper. It's like 3 to 4 times more copper in an EV versus an ICE vehicle. But then aluminum, right? That's important for the lightweight part of it, making it lightweight. And the nickel is massive, right? It's obviously used in the batteries, and it's again, people are concerned that we might not have enough nickel to deal with the demand from the EVs. And cobalt, and I know some people are, frustrated with cobalt because of where, it's mined mostly in the DRC. But I remember talking to someone saying, could we just take cobalt out? And they said, no, cobalt is needed to maintain the stability of the battery. So it prevents it from overheating. And this gentleman said very nicely, he's like, it prevents the car from bursting into flames. So cobalt is very important. And so I thought, I will not forget that. And lastly, we have iron ore in there, which is, it represents steel, right? And that is really important for the chassis and the body of the vehicle. But again, we believe that this is going to be an attractive product because of this. It is the product of the future. And we saw, as we talked earlier, when China had its lockdown, the sector that got hurt the most was industrial metals. It came down 30%, but EVMT hit a low in July. And so since then, it has been doing really well. And this China reopening story and this electrification of transportation, it's a really impressive story. And that's why for investors that are looking for something that they can invest in now they can hold for the next 5 years, and it will grow and adapt as the market for these electric vehicles changes, I like this product. I like it a lot.
Yeah, this is definitely a very interesting product. And I do believe that energy transition and particularly EV battery materials, these would be a significant investment opportunity in the coming years. So definitely worth a look. Now, I also wanted to talk about the investment case for agricultural commodities. So we discussed that inflation has eased all over the world, but food prices have remained stubbornly high. And that is what we experience whenever we go to grocery stores to buy our food items. And for grain prices, I think the outlook remains kind of uncertain because the war in Ukraine shows no signs of ending anytime soon. And in fact, food prices were going up even before the start of the war. And that is mainly because of droughts and climate change in various parts of the world where the food producing areas in the world. And climate change remains a big concern for everyone, and particularly for food growers. So tell us about your outlook for agriculture commodities for this year.
I love this question. Now, if we were to look at the sectors, the different commodity sectors by volatility, agriculture has the lowest volatility, right? So first is energy, then industrial metals, right? Then agriculture. So, and that's where some people that are cautious and they want commodities, but they want a lower vol product, like they look to agriculture. And you're right. We talked a little bit about the China reopening story being very bullish for this sector, but also the war in Ukraine. So one of the issues that we were really concerned about was fertilizer, right? As natural gas was skyrocketing, natural gas is used to make fertilizer. So fertilizer costs went up exponentially, and all these costs for the farmers were going up. I was actually on a crop tour, and we talked about all their costs going up. And it's not just the natural gas costs making fertilizer more expensive, the diesel costs, right? There was a scarcity of diesel for a while there. So the cost for all their diesel farming equipment was a problem, but also that increase in interest rates, the cost of borrowing that I mentioned earlier. This really was impacting the farmers. And they talked to me about, well, last year when we were leasing our land or leasing our farming equipment, we got 1% interest rate. Now the interest rate's like 7%. So the cost to the farmer is going up. And also we were surprised with the war in Ukraine, how much wheat Russia was able to get out. They really, again, they had a great harvest and they were able to get a lot of wheat onto the market. So right now, as I said, that war risk premium is not in that price. But it is going to take many years for Ukraine, even if we had peace tomorrow, it's going to take many years for Ukraine to come back. And people are estimating 3 to 5 years for them to get back to being that breadbasket of Europe. So that is a factor too. But the other, as you mentioned, weather. Right? Weather is the ultimate driver, right, of this. And the climate change adding volatility is a very big deal. And you look at Argentina specifically, having 3 years of La Nina, an astounding 3 years, right, which causes extreme dryness. And that impacts crop yields. And that's why, again, when I was with these farmers, I'm like, guys, okay, climate change, it's really bad for you, right? Because it makes it harder for you to plan. And some of them are like, no, actually, climate change has been sort of good because it's making the planet warmer and we can plant corn in places that we weren't able to plant corn. I was like, guys, bigger picture, okay? And they're okay. It is a concern, obviously. But then back to that same theme of the energy transition. Remember, part of this is the energy crops, right? Think of corn and sugar for ethanol and soybeans for biodiesel, right? There are people that are estimating that we don't have enough land, right, to plant all of these things to make enough of these energy crops. So that is a concern too. So that's why I'd say a low vol investment. And again, we have to be watching the weather and all that, and supply and demand, right? But that's important. Remember, the grains feed the livestock, right? So when people they want more meat, we have to have more grains to feed the livestock to have more meat. So again, I would say that I'm cautiously optimistic about the agricultural commodities. And I think for people that like that lower volatility, this may seem like an industry that they want to invest in.
Excellent. Now you offer 2 ETFs for gaining exposure to agricultural commodities. DBA is your older product. And last year you launched PDBA, which is the Invesco Agriculture Commodity Strategy No K1 ETF. So when investors consider these 2 ETFs, and you explain the differences between PDBC and DBC. So is PDBA the PDBC version of DBA?
Yes, yes. And I know those tickers are a mouthful, but yes, exactly right. And actually, we've had DBA for a long time, right? And we had a lot of interest, especially slightly before the war started. But once the war started, like we saw massive inflows into this product. But we had almost daily, I got requests for, could you please create a no K1, 1940 Act version of DBA? I started keeping a little tick chart, and when I got to 40, I thought, yeah, I really need to make sure this is something that we're willing to launch. So we did. We launched it last year, and it's the same thing. It's actively managed with those portfolio managers that are experts, right, in commodities, and it will have the 1099. So the problem with DBA was that only some of the commodities use that optimum yield methodology that I explained earlier because of liquidity. Remember when I said PDBC and DBC, they only have 14 commodities because a lot of the other ones were too illiquid to go out the curve. So when DBA was created, only corn, soybeans, wheat, Kansas wheat, and sugar were actively going out the curve. The rest were front month referencing. So we also have all the livestock, right? Live cattle, lean hogs, feeder cattle. And then on the softs, the cocoa, cotton, coffee, like the 3 Cs, right? And so they are not very liquid. So that's why, in DBA, the original version, it was just front month. Now with the active version, our guys can go out the curves. They have total flexibility to go where they think that they should be and put their exposure out the curve. And they can do those relative value trades too. Like for example, sugar recently hit like almost a 7-year high due to news out of India around exports. India is a very big producer of sugar, and there's concerns that they won't be exporting as much. So as I said, sugar hitting this really high level. And so it's important to get exposure to agricultural commodities. And the beauty of these products together is that it gives you diversification, right? So you're not just only in wheat or only in corn, right? You have diversification across the livestock, the softs, and the grains. But again, I think that, PDBA, since it was issued in this new regime of lower fees, it is priced quite attractively at the 59 basis points. So that's why we're seeing a lot of people being attracted to that.
So switching gears a little bit, I wanted to talk about the role of commodities in a portfolio. So 60-40 portfolio had a terrible performance last year. And we also saw that bonds and stocks, they were highly correlated and both fell and investors were hurt. So as commodities did quite well, some of the alternative strategies also did quite well. Strategists started talking about adding some commodity exposure in a core portfolio. So tell us about the best investment case for commodities in a portfolio and how much exposure to commodities do you recommend to your clients?
So I want to start with that second part first, because I feel that it's very important that investors understand we are a volatile asset class. I've said it a few times, but especially need to say it when you're choosing how much to use. And a little commodities goes a long way, right? So when we looked at initially in 2021, the big story was hedging inflation. And we looked at what makes sense from an asset allocation. So we looked at the beta to inflation. So this sensitivity of commodities to inflation. And it was a very high number, like over 12. But we took that number and then we take our portfolio, 100, we divide it by the beta, and we get an approximate asset allocation number, which worked out to like 8.4 or something like that. But what I would say to investors is, even though the math works out to about an 8.4% allocation purely to hedge your inflation risk, you don't even need that much. You need more like 5%, because you will have other things already in your portfolio, such as some equities and things like that, maybe some real estate that will also hedge inflation. So that's why I feel very strongly about this 5% number, because I feel that, remember, this is investing. This is not gambling. right? So when you are a prudent investor, you want to start with something 5% or lower, right, for this asset class. And that's what was happening. Like I said, last year I've been here at Invesco almost 2 years, and everyone was making money on their commodities. So like, okay, I started at 5, now I'm at 10, I want to go to 15. I'm like, hold on. Right? It depends on what your goal is or why you're using commodities, right? So like I said, the inflation hedge, 5% is more than enough. On the diversification front, some people would argue that they want a higher percentage for diversification, but again, commodities are volatile, so I wouldn't go too much higher than that 5%. But also the geopolitical thing, we haven't really talked about gold at all. Sorry, that's my error. But gold is a great safe haven hedge, and that's why I say sometimes when people are looking for there's wars, whatever. Yeah, gold is something great to own if you want a safe haven hedge. But I like it inside our products rather than on its own, again, for that diversification. But that's, again, part of the geopolitical hedge. So that's why I'd say, remember, commodities are volatile. A little goes a long way. In case you shouldn't really need more than 5%. But I get, once you feel like you understand commodities, you're welcome to increase it. But commodities can be very humbling. Right. People, we mentioned natural gas, right? Natural gas hit a high of $10 per MMBTU this past year, right? We had Putin shutting down Nord Stream 1. We were worried that Europe wouldn't have enough natural gas. They were shutting down some of their industrial demand for natural gas. Even the consumers, retail, were turning down their heating, to express, how important it was for them to support Ukraine. So, and again, that's natural gas can be really brutal. We only have a 5.5% allocation of natural gas in our main products. So, and I like that. I like that nice small allocation of natural gas. But again, commodities can be humbling. And that's why I'd say go cautiously, educate yourself, like listening to a podcast like this, learn about the commodities. And commodities are all around you, right? Everything that you're touching, everything you're eating, right? Where we live, right? Commodities are all around us. So once you start an interest in these things, and we put a lot of information on our website, right? Invesco, for PDBC, we have this section called Documents, and we post them monthly in there, and we're constantly posting our decks in there. And our goal is to educate people, because so many people have not had commodities in their portfolio for many years. And so again, it's that toe in the water, educate yourself, and go cautiously. As I said, 5% usually is enough for most investors.
Excellent stuff. I like your comment that commodities can be humbling. So no more than 5% in a portfolio. Kathy, thank you so much for joining us today and for sharing your excellent insights.
My pleasure, Nina.
So that was Kathy Krisky of Invesco. Now let's talk a little bit about the ETFs that investors could use. We talked about PDBC, which is the most popular ETF to gain broad exposure to commodities. This has about 6.5 billion in assets, and with an expense ratio of 62 basis points, it is much cheaper compared to its older counterpart, DBC. And this is actively managed, no K1, as Kathy pointed out. Now, if you want to invest in agriculture commodities and you want a broad exposure, then DBA is the most popular product as of now, with about 976 million in assets. And this has an expense ratio of 91 basis points. And as she mentioned, Invesco launched the no K1 actively managed version of DBA last year, PDBA. This is still small, has about 15 million in assets, but much cheaper with 59 basis points expense ratio. But I wouldn't be surprised if this ETF quickly gathers assets from DBA, as we saw in case of PDBC becoming bigger and more popular than DBA. PDBC, sorry. So, because investors generally do not like those K1 headaches. And then let's talk about ETFs that you could use for gaining exposure to metals which are used in EVs and other energy transition themes. So the one by Invesco was the first in this space, the ticker symbol EVMT that we discussed. This has about 23 million in assets and has an expense ratio of 59 basis points. Subsequently, more providers have launched products in this space. The one by GrainShares, ticker symbol KMET, is about the same size, 23 million. That has an expense ratio of 79 basis points. Then Elements launched CHRG, which has about 6 million. The latest entrant is by USCF, ticker symbol ZSB, which has about 3 million in assets so far. And I'm very sure that we will see more products in this space because there's so much investor interest in the theme, and there is so much appetite for commodities which are critical to the energy transition, which will be so important in the coming years. So a quick word about these ETFs, which are small in size, low AUM, and are thinly traded. It is important for investors to use limit orders when they trade in thinly traded ETFs. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.